once you log into your Korean's account, let's say if you like to subscribe, on the left side, there is a online form. So go to online form and IPO subscription. Then you will continue by tapping the ETF name and click apply. And then once you are directed to the next page, you can choose the quantity that you want. Minimum is 1,000, so it's up to you. Tentatively, there is a promotion. So for every 10,000 units subscribed, there will be a $20 cash credit into your points account. Okay, so once you have chosen your quantity, you can carry on to read the terms and conditions and all these things, and then submit, type in your password to submit. So this is roughly the flow for it. So once again, along the way, as you have any questions, do drop them in the Q&A. So let me share with you, so today we have Mr. Ong Xun Xiang from Lion-OCBC. He's the ETF master from the Lion-OCBC side. So yeah, so let me pass the mic to him now.
All right. Hey, thank you, Mu-Ming, for the introduction, and good evening, everyone. Thank you for joining us today. I'm Xun Xiang from Lion-OCBC Investors, and you can call me LGI's ETF guy. Okay, so right now I will share screen. All right. Okay, Mu-Ming, before I start, can you see my screen? Just confirm, hear me clearly, can see me. Okay.
Yes, we do.
All right. Okay. So good evening, everyone. Thank you for joining us today. And I'm here today to share with all of you about our new ETF, which is the Lion-OCBC Securities APAC Financials Dividend Plus ETF. And if there's anything I want all of you to take away, it'll be two key things to remember. The first is about this ETF, which is the world's first APAC Financials ETF. And the second thing would be something that is more interesting and of interest to some of you. It will be that this ETF will be paying minimum 5% per annum quarterly distribution. So I repeat again, pay minimum 5% per annum in quarterly distribution. So this ETF is basically designed to help our investors earn stable dividends, but at the same time being able to invest in APAC's financial strengths. So that's why the tagline here, as you see. And before I dive deep, introduce more details about the ETF, maybe let me first briefly introduce LGI in case some of you are not so familiar with us. Okay. So LGI, we are one of Southeast Asia's leading asset managers, and today we manage around 71 billion Sing dollars of assets for our clients. And here are our ETFs, where we started our ETF journey back in October 2017, where we partnered with Phillip here to launch our S-REIT ETF. And since then, between December 2020 to April 2022, within 18 months, during this period, we launched 3 ETFs within 18 months. So this translates to roughly 1 ETF for every 6 months. And earlier this year, we launched the Lion Nomura Japan Active ETF around 3 months ago. And this was our 5th ETF. And right now, as we speak, we are launching our 6th ETF and opening it up for subscription for investors like you and me. And among our ETFs, we started our journey back in 2017, and today we are at around almost 860 million in terms of AUM, and also one of SGX's top 5 ETF issuers. And if we apply the cutoff, right, as of end of 2023, you'll notice that actually 3 out of our 4 ETFs, if we just apply the strict cutoff of 2023, are top returning ETFs among their respective segments. So for example, our S-REIT ETF was the top returning ETF among SGX listed ETFs in 2023. Hang Seng Tech was top returning for China equities ETFs in 2023. And also our Singapore low carbon ETF, which was top returns among Singapore listed Singapore equities ETFs in year 2023 and also Q1 2024. So since our inception, actually, we have in fact outperformed MSCI Singapore and the Straits Times Index since inception. So because of this, all these give us more and more confidence and also ability to keep introducing and launching new ETFs for our investors. And if you notice, among the top 10 ETFs held by retail investors, our ETFs sit within the top 10 held by retail investors like you and myself. And if we zoom into the segment of SRS investors, we'll notice that our ETFs are also within the top 10 ETFs held by this specific segment of SRS investors. And we look at in terms of trading volume and trading turnover, our ETFs are also within the top 10 in year 2023. For our Hang Seng Tech ETF, it was the top traded ETF for 2 consecutive years in 2022 and 2023. And with all these are possible because we are domiciled and headquartered within Singapore. And we are committed to delivering quality ETF products and solutions for Singapore investors like you and me, and also the entire Singapore ETF ecosystem. And that's what prompted us to co-launch our new ETF, the 6 ETF together with OCBC Securities to be able to brand it as the APAC Financials Dividend Plus ETF. So some of you might ask, actually why the financial sector? Isn't it like a plain and boring sector? So actually, if you think about it, plain and boring, but it's a sector that also survives centuries of wars, of crisis. So this means actually it's a resilient sector and mainly includes companies that provide services and products that focus on the growth, storage, and transaction of money and assets. So imagine, right, back in ancient times, we actually started with barter trade of seashells, and then after that moved on to trading of gold to be able to exchange for goods and services. And then after that, in recent times, we moved to paper fiat currency. And after that, to credit cards, where we are able to pay first using the credit card, and then after that, pay the bill later. So we have even evolved further into mobile payments via QR code. And right now, at the most frontier and modern end of technology, central bank-backed digital currencies. So the financial sector, as we see, has survived and prospered throughout centuries and is an essential capital provider for economies worldwide. So it is a key thing and key feature because the financial sector has been an essential capital provider for economies worldwide. And that's what keeps it going and surviving centuries and prospering throughout centuries because it provides capital to power economies worldwide. And when we talk about the financial sector, it's not just purely about banks. It's also about an ecosystem, which includes investment management, for example, like Lion Global Investors, insurance, brokerages, which definitely includes Securities here, and also exchanges, for example, like SGX, where we're listing this ETF on. Because the financial sector is basically a well-rounded ecosystem that helps to smoothen the flow of capital and also enable economies to trade globally. So remember, key thing, the financial sector is an ecosystem that helps to smoothen the flow of capital. And the next thing would be, other than why financials, why APAC Financials? So I mean, we have covered in terms of the financial sector, but APAC is an interesting region because more than 55% of the adults within APAC are underbanked. And this represents the largest opportunity set across various regions. And during this opportunity set, which we identified and noticed, APAC banks can actually grow even further by serving the underbanked within developing Asian countries. So as we speak, the financial sector is already among the world's most profitable sectors, generating more than 12 trillion in terms of revenue in 2022. And with further room to grow within APAC, there's actually a lot more opportunities for it to tap. And there are a lot more opportunities because APAC has a high savings rate. It's much higher than the world average savings rate of around 25%. So if you notice, APAC's savings rate is at 29%. And there are two key drivers within APAC for the Asia Pacific's high savings rates. So for example, Singapore, you see it at 43%. And for ASEAN, you see it at around 34.5%. So all these are high savings rates that help to deepen the foundation for growth because it deepens the deposit base and also helps to generate and provide more capital to fuel economic growth. So it's an important feature here because when savings rate is more, because banks work by a fractional deposit system. So if you have more savings rate, it actually means more deposits and means more ability to lend out in terms of loans to be able to fuel economic growth. So because of this, you will notice that out of the world's top 30 banks by market cap, 13 of them are APAC banks. So it's around half of the world's top 30 banks. 13 out of 30 banks are APAC banks within the top 30. So all these help to improve economic resilience for the APAC region. And when we talk about banks, it's also a mix of developed markets, for example, like our home country, Singapore, Australia, Hong Kong, and Japan, but also about developing markets, for example, like Indonesia, Malaysia, and Thailand, which are expected to grow even further in terms of economic growth rate. And APAC banks, for example, like the clear examples we've seen would be our 3 local banks, typically pay consistently high dividends. And all these help to lay the foundation for stable dividend income. Because a lot of APAC banks, they usually pay around 50 to 60% of their distributable income as dividends to the end investor. So what you have noticed is a consistently high dividend payout in terms of track record. So all these help to lay the foundation for stable dividend income because APAC banks tend to pay quality income. And another part is also about it being an ecosystem. So the financial sector is beyond just banks. It also includes insurance. So if you see, APAC's life insurance industry was among the world's largest in 2021, with 5 Asian countries among the top 10 global markets. And key thing here is, if you notice, until around 2026, APAC's emerging markets like Indonesia, Thailand, and Malaysia are expected to grow at an annual growth rate of around 20% per annum, respectively. So what we see here is that the insurance sector actually presents a much higher in terms of growth rate and also a high growth segment. So banking is just part of the financial sector. There's also insurance, which is another high growth sector, and also other areas which make it an ecosystem to help to smoothen the flow of capital across the entire financial value chain. And if you notice, the ETF's name is Lion-OCBC Securities, APAC Financials Dividend Plus ETF. So some of you might ask, actually, what is in the plus? So there are 3 plus within this ETF. The first is about cushion profitability. This is the first catalyst because we have noticed that banks in the past 2 years globally have posted decade high profits and also return on equity. And all this has been powered by the US Federal Reserve rate hikes that help to power an improvement in net interest margins. So all these have helped to boost the sector's profits. And in 2023, the financial sector ROE globally is expected to reach 13%. So this is around 50% higher than the 9% 14-year average ROE. So, and during this kind of sector, we are in terms of landscape, we are seeing unfold. To unfold, the well-capitalized banks are actually more likely to maintain profitability. So because we are already seeing, although inflation in the US remaining sticky, there have been some calls of potential rate cuts happening. It's just the number of rate cuts, whether it's 1 or 2, that's about to happen. And during this kind of situation, and also the kind of context and landscape we are seeing to unfold, in this kind of situation, well-capitalized banks are more likely to maintain profitability. So it's an important statement, which I will cover much more later when we talk about the index constituents. So for now, remember that well-capitalized banks are more likely to maintain profitability because these ETFs covers the top 30 largest and most tradable APAC financials, and they tend to be much more well-capitalized. So this is the first catalyst on cushion profitability. The second will be the part about the tilt towards Asia and the rise in APAC wealth. So as you see here, based on the Deloitte and McKinsey study, banks grouped along the Indian Ocean tend to, which definitely already includes Singapore, are home to half of the world's best performing banks. And in the next 10 years, more APAC banks are also expected to join the top global 100 banks. So all these are expected to unfold, and global wealth is expected to exceed $500 trillion this year. So this is nearly 5 times of the world's GDP. And with the biggest wealth source expected to come from APAC, which is the very region we sit in right now. This is expected to take up roughly 40%. So all these rise in APAC wealth will help to catalyze the growth of APAC Financials because they help to increase the deposit base, increasing the potential amount of loans. They also help to increase the assets under management within the APAC region to be able to help generate further growth within the different stock market and bond market, and also different asset classes. So all these are important because this tilt towards Asia and the rise in APAC wealth will help to catalyze the growth of APAC Financials. So this covers the second point, the tilt towards Asia. And the third point would be the financial institutions pivot towards capital-light models. And based on McKinsey study, what has been noticed is that capital-light models use much less in terms of balance sheet, but actually bring higher return on equity and net income. So to put into perspective, in the past 6 years, transaction activity actually used only 16% of balance sheet or capital, but actually brought 33% of profit. So 16% of capital, but bringing 33% of profit. So it's like a 2 times multiplier you see. So because of this benefit of our capital light models and activities, a lot of financial institutions are embracing digital transformation to go capital light and go digital. So specifically, DB has mentioned that digital customers are consistently more valuable with an increasing share of income, sustain higher income per customer, and better efficiency. So with all these, what we notice and observe is that being capital light and going digital helps to improve profitability for APAC Financials. I'll discuss this much more later in the other constituents. But for now, key to take note is that being capital light and actually going digital can help to improve profitability for the APAC Financials. And with this, what we notice is that APAC Financials are at an attractive entry point right now as we speak. So if you notice, if we compare against the STI, which consists of roughly 50% of the 3 local banks like DBS, OCBC, and UOB, the index is actually trading at a P/E ratio of 10, while STI is trading at P/E ratio of 16. And if you compare to the IHS REIT Leaders Index, which consists of mainly the leading S-REITs, the IH APAC Financials Dividend Plus Index is actually trading at a much lower, it's like a 50% lower kind of price to earnings ratio. So it's interesting because P ratio is actually for the, especially for the S-REIT Leaders Index, despite all the high interest rates that have actually helped to depress the REIT prices, they are still actually at quite a high PE ratio. But if you compare to the APAC Financials Dividend Plus Index, in terms of the PE valuation is still rather favorable and low. And next thing, if you compare to the price to book in terms of ratio, it is significantly lower than the Straits Times Index, which already consists of the 3 local banks. But on the flip side, if you compare to the IHS REIT Leaders Index, it's actually quite comparable. So it's much lower in terms of the price to earnings ratio, but actually quite comparable in terms of price to book ratio. So this is an important point because it's actually quite comparable, but actually in terms of PE ratio, it's much lower. Price to book quite comparable. And next thing, if you look at the net dividend yield here, right, it has a net dividend yield of 5.9%. This is much higher than STI, which is at 5.1%. So 5.9% and 5.1%. So 5.1% already consists of the 3 local Singapore banks. And if you compare to the IHS REIT Leaders Index, it's still quite comparable. It's 5.9% and 6.3%. But actually, there are a few fundamental differences between Singapore REITs and also the APAC financial institutions. So banks, as we know, pay out roughly 50 to 60% of their distributable income. So they are able to reinvest the 40 to 50% of their extra income from the distributable income back into retained earnings to fuel growth for the APAC Financials. But next thing, if you look at the IHS REIT Leaders Index, under the Tax Transparency Act in Singapore REITs are required to pay 90%, at least 90% of their distributable income as dividends, as distributions. So this leaves roughly around 10%. So if you compare, actually S-REITs, they pay out 90% of their distributable income, but they are still at a 6.3% in terms of net dividend yield. For the APAC Financials ETF or index, they pay out roughly 50 to 60%. They still have the remaining 40 to 50% to reinvest, but they are already at a 5.9% in terms of net dividend yield. And as we speak, the growth catalysts are long-term and still take time to be priced in because all these are long-term trends we're talking about. And some of you might ask, US rate cuts might eventually come this year. So how will this impact APAC Financials? So I can address this upfront. I mean, there are even other reasons I can talk about beyond just this slide. So the first part is about the financial sector being an ecosystem with businesses that react differently to rate cuts and have different interest rate sensitivities. So if there are expectations of US rate cuts happening, all these can actually drive investment activity. So because if you are, for example, like a normal investor, if you know that if you know, and in fact, if you already see that your savings accounts, interest rates, the FD rates actually being reduced, you have to earn and invest to be able to earn a higher return. So all this will encourage more risk-taking investment activity. And because of this, all these actually are redirecting capital towards wealth management, towards insurance businesses to be able to earn a higher return compared to risk-free products like savings accounts and also fixed deposits. So all these are one factor because it provides this ETF and also the financial sector provides ecosystem diversification. And another point in terms of diversification, if some of you already read our Financial Horse article, you will notice that the ETF also provides geographical diversification because it covers constituents across different countries. And because of this, each of these countries are actually at different points of their interest rate cycle. So key examples, for example, like China, they have been cutting interest rates since 2021 and 2022. So while US were hiking interest rates, actually China was already cutting interest rates. So they have been on an expansionary fiscal and monetary policy stance. And next part, if you compare on Japan, so Japan, back in March, around mid-March, they removed the negative interest rate policy. And since then, they are expected, in fact, to keep hiking interest rates. So what actually have powered the improvement in net interest margins for the non-Japanese banks are now expected to help the Japanese banks and Japanese financials. Because when there's further increase in interest rates, the Japanese banks now are able to actually earn the higher net interest margins. So all these are actually captured within the ETF through geographical diversification. And for the banks themselves, for those that are affected by US rate cuts, they're still able to protect their net interest margins from lower interest rates by increasing positions in longer term fixed rate assets, for example, like buying longer duration bonds, or the banks dispersing and issuing longer term loans. So one prime example would be DBS, which already made a conscious decision to put $30 billion of fixed rate assets into Q3 and Q4 to protect against lower interest rates that are about to happen and unfold. So because of this, to sum up, the financial sector is an ecosystem that offers diversification across business units. And also at the same time, the ETF helps to provide geographical diversification across different countries because a lot of them are at different points of the interest rate cycle and economic cycle. So these are the two fundamental reasons on the economic ecosystem diversification and also geographical diversification that this ETF will help to offer to cushion against different macroeconomic events, such as the US interest rate movements. So with this happening, that's why we launched the Lion-OCBC Securities. APAC Financials Dividend Plus ETF. And this is the world's first APAC Financials ETF. And it tracks the APAC Financials Dividend Plus Index that tracks the 30 largest and most tradable APAC financials. So it's designed to provide access to stable dividends and also at the same time potential growth within the financial sector. So the country index universe includes Australia, Hong Kong, Japan, Singapore, South Korea, which is an interesting but underinvested market, Indonesia, Malaysia, and Thailand. So it follows like a 3-step in terms of index methodology and portfolio construction process. So first step is about eligible sectors, which includes banking, insurance, investment services. The last one would be specialty finance and services. So this is actually an important classification because the banks, the digital banks, for example, like C and Grab, they're actually parked under specialty finance and services. So this is what actually makes the index future-proof. So if one day, for example, they were to manage to grow big enough in terms of free float market cap, they exceed 1 billion in the USD 1 billion in terms of free float market cap, and they start paying consistently high dividends for more than 2 years, these digital banks could be included into the index. And this is what makes the index future-proof, to be able to capture growth within the sector, but also at the same time still offer stable dividend payouts to investors, to income investors. And the next thing to notice will be about the 2-year average dividend yield. So key thing we use is 2-year instead of 1 year, because some companies or financial institutions could pay extraordinarily high dividends within the first year. So because of this, we use a 2-year to ensure consistently high dividend yields. And the next will be about index selection and weighting. So we use a USD 1 billion in terms of free float market cap. There are also 3 other weightage caps involved, a 7% single stock weightage cap to ensure diversification across stocks, a 20% country weightage cap. So this 20% country weightage cap is important. Later I'll cover even more when I talk about the different index constituents, because it helps to cap and limit country exposure to certain countries, but also at the same time help you assess the high dividend yields offered by certain markets. And after that, there's also a 5% weightage cap for Indonesia. So what you end up in the end is a portfolio of 30 APAC financials constituents that is weighted based on free float market cap. And there's also semi-annual rebalancing in March and September. So there are 3 key features about this ETF. I'll put it very simply. It's very easy to remember. FIG, because it stands for Focus on Income and Growth. So it's designed to help investors focus on income and growth. So when we talk about focus, it's talking about the top 30 largest and most tradable APAC financials. Income, minimum 5% per annum quarterly distribution. And also when we talk about potential capital appreciation, it will be about the growth element, which is offered by the different constituents to help propel it forward in terms of potential capital appreciation. And the index was launched on 2nd of February. And since its launch, it has actually performed quite well. It's generated 8% in terms of return as of 31st March. And when compared to the STI, the performance is roughly 1.9%. It really outperformed the STI by 6% during these 2 months since its launch. And when you compare to the IHS REIT Leaders Index, it's actually outperformed the S-REIT Leaders Index by 11.3%. So all these we are comparing against the Singapore market benchmark. And because of this, we can safely assume that the APAC Financials Dividend Plus Index has outperformed comparable indices since its inception on the 2nd of February. So it was incepted on 2nd of February, and since then we have seen it outperform other Singapore market benchmarks. And if we talk about the index characteristics, if you notice, among the country breakdown, you see a colorful mix of countries. You see Japan, Australia, Singapore, roughly at around 20% each. For Singapore, it consists of the 3 local banks. You see Hong Kong, where the Hong Kong listed Chinese financials are inside. But because of the 20% cap, it's actually capping the Hong Kong exposure, but also at the same time helping to offer the access to the high dividend yields. You also see South Korea, which consists of the three constituents, Hana, Shinhan, and also KB Financial at around 16%, and also one Malaysian constituent, which is Public Bank. And what you get in the end is a financial sector portfolio that's diversified across APAC. And here are the index constituents. You see top three constituents are the three local Singapore banks, DBS, OCBC, and UOB. So if you compare the top 10, top 15, you will see the Korean financials like KB Financial, Shinhan Financial, and also Hana Financial inside. And for the Japanese financials, for example, like Sumitomo Mitsui, Mizuho, they are also captured within the ETF among the top few constituents. And also notice the top big four Australian banks like CBA, NAB, Westpac, and ANZ inside. And remember that I previously mentioned about a 20% country weightage cap. So this is where the magic happens for the Hong Kong listed Chinese banks. So the Hong Kong listed Chinese banks or Chinese financials actually have quite a high dividend yield of around 8 to 9%. So it's around 8 to 9%. For example, like ICBC, BOC, they are paying at around 8 to 9% in terms of dividend yield. But at this kind of stage and juncture, they are also undervalued, and not a lot of investors might be so comfortable to approach or invest in these different constituents specifically or individually. So because of this, having it as a 20%, as part of a 20% country weightage cap, helps make it more comfortable for investors, but also at the same time help investors be able to assess the high dividend yields. There are a few reasons, because if you break down the 20% country weightage cap among the three local banks, there's only 20% divided by 3. But in China, a lot of the Chinese banks and Chinese financials, for example, ICBC, BOC, all these are among the world's largest financial institutions. And in China, there are so many banks and big financial institutions, the 20% cap is actually split across a lot more constituents. So because of this, that's why you will notice that a lot of the Chinese constituents listed in Hong Kong, they are not even within the top 15, except for ICBC. So because of, or except for CCB, a lot of them actually are split across many constituents. So this helps investors actually assess the high dividend yields offered by these Chinese financials, but at the same time, limit the country exposure to China. So because of this, you get diversification across geographies, across countries at different points of their interest rate cycle, still get access to stable dividend income and also high dividend income. And that's why and how we are able to offer the stable 5% per annum quarterly distribution safely for investors, which we are confident to be able to meet, to be able to pay out, to set a proper track record for this ETF and offer it going forward to build a track record like how we did for our Lion-Philipp S-REIT ETF, where we paid consistently distributions even during the COVID pandemic. Because we are part of a conservative group, we want to set the track record and also a credible track record to be able to help investors gain access to sustainable passive income. So right now, I'll pause here and I'll actually talk about two key constituents of this ETF. The first one would be National Australia Bank, which is one of the biggest banks within Australia. And second would be KB Financial, which is a huge financial institution within South Korea. There's often an underinvested market. So the first would be about National Australia Bank that has delivered extremely strong performance in 2023. Cash earnings was up around 9%. Profit was up around 16%. And it was Australia's top business lender with around 22% in terms of market share. And this is also a prime and case study example of a financial institution that that has strong growth in terms of digitalization and that's propelled forward. So for example, right, for its core business and private banking union that focuses on SME customers, the net profits actually grew around 22%. And when the company actually did further attribution, It was attributed actually to digitalization of account opening, which actually contributed 50% in terms of new account opening since 2020. So this actually ties back to the third catalyst about the pivot towards capital light and digital models. So all these have helped to contribute 50% in terms of growth in new account openings. And since then, between the period of the last 15 months, from January 2023 to March 2024, within this period, excluding dividends, the share price actually rose by 25%. So 25% in the last 15 months for this specific constituent, National Australia Bank. And the next would be about KB Financial, which is in Korea. So Korea is an underinvested market because a lot of the Korean financials are actually in Hangul, in Korean language, which is not really accessible. And for many people, because we don't really know how to analyze Korean financials. And because of this, it's actually a hidden gem within a market that is underinvested among the world. And is an interesting constituent which achieved record high gross operating profit in 2023. So it was actually up around 18%. And it is also a constituent with two different insurance arms. So it actually acquired other than having its own insurance arm, which is KB Life, it actually also acquired Prudential Financials, Korean insurance units for roughly $2 billion. And this merger was then effective as of January 2023. And since then, between January 2023 to March 2024, the share price actually grew by 50%. 50% in the last 15 months. And besides this, actually analysts have identified roughly a 15% in terms of upside potential against the average target price. So 50% appreciation in the last 15 months, excluding dividends, and still a 15% in terms of upside potential identified. So this is what investing through an ETF can help investors. You get to invest into the hidden gems, but also at the same time, geographically diversify your portfolio. So you are not so hit by different macroeconomic events across the world because it's more cushioned, more geographically diversified across countries that are at different points of the interest rate cycle. And if you notice, among the for the past 4 years, KB Financial actually grew its net profit at more than 8% per annum and has remained well capitalized with a Basel III CET1 much above the Basel III requirement. And remember, for the first catalyst, I mentioned about cushion profitability, where well-capitalized banks are more likely to maintain profitability. So the previous one was about the third catalyst, where the pivot towards capital-light models and digital models help to increase profitability. And in this kind of case, well-capitalized banks are more likely to maintain profitability. So through these ETF, what you notice are two constituents, interesting constituents that demonstrate and are case study examples of the catalyst within the financial sector. And to summarize, the Lion-OCBC Securities, APAC Financials Dividend Plus ETF helps to offer investors a focus on income and growth. So focus on the top 30 largest and most tradable APAC financials. Income, 5% per annum quarterly distribution, and growth, potential capital appreciation in the APAC financial sector. So there are a few key things, easy to remember. The SGX ticker will be YLD. Sounds very similar to yield. And also remember 5%. If you look at your hand, you will notice 5 fingers, as easy as to remember as 5%. Because 5% per annum quarterly distribution could be a good yield for a lot of investors here. And we hope you take this opportunity to earn stable dividends and invest in APAC's financials today. So right now, Securities, they are also running a promotion until the 2nd of May, where if you invest every 10,000 units, you get $20 in terms of cash credit. So for example, right, if you are an investor who invested 450,000 units, you'll get $500 in terms of cash credit. So it's a very interesting promotion, which we see it being offered because there are usually not so many IOP promotions happening. And during IOP, what you get is that when you invest into the ETF, you buy at IOP price of $1. If you buy after listing, you could be subject to the bid-ask spread by the market maker. But if you buy during IOP, your entry price will be fixed at $1. And you can also take advantage of this IOP promotion, which is happening exclusively during IOP. So right now, I'll pause here and also pass the time back to Mo Ming, who will cover more information about how you can subscribe and also take advantage of this interesting promotion. So Mo Ming, please.
All right. Thank you, Xun Xiang, for giving us a very comprehensive sharing. Right now, let me answer two questions over here while at the same time share my screen over to the website. So, okay, there is one question. What are the relevant charges on the PoyEMS platform? So, if you are using the cash management account, which is linked to your CDP account, then there will be a $10 charges together with GST. This is mainly for the CDP charges. If you are using any other account, there will be zero commission. Okay, so we have done this question. Another, yes, so another question is also answered already, which is the cash credit. Next thing, give me a moment. All right, let me share with you again. Can you guys see the slides again on how to subscribe? Let me know if you don't. All right, so let's say you are interested to subscribe to this LLP. So once you log into the PoyEMS 2 platform on your laptop, so on the left side there will be an online form. Click online form and then IOP subscription, and then eventually you click the name and then click apply and choose the quantity that you want. Minimum is $1,000, and once you're done, click next, agree with the terms and condition, type in your password, and you're good to go.